Hi, this is Dave Aquino with Value Charts, and this is the free video for Friday, July 1st, 2016. So every once in a while, we have a little bit of difficulty with our 11-hour option trade. So yesterday, we put our trade on Google. I show this to you in a 10-minute chart. We had this on on a 60-minute chart, but just to make it easier and to illustrate something, I'm putting it on 10 minutes. So we did a bullish put credit spread here right around 12:30 when the markets looked like Google was starting to pull over, drop off. So the short strike for our credit spread was 705. Basically what that means, as long as Google stays below 705, the trade is successful. We get to keep all the premium that we sell. However, later in the afternoon, we get this slow and steady march from where we got in to $699, $700, and I told my traders, be careful. If we break above 700, you could go to 705. So go ahead and utilize what we call a delta neutral strategy, in which that we buy additional calls in Google to offset any of the loss that we get in the credit spread. So what happens is, if you had followed that strategy, Google kept going higher, so that the calls that you bought right here were adding or offsetting some of the loss in the credit spreads. Here in the morning, the momentum kept going with Google. Those calls kept increasing in value. Now, you were losing money on the credit spread, but you were making an equal or increased amount in the directional calls. So because I overweighted the number of calls that I bought down here, when I got up to this point around 710, which was the long strike in the credit spread, I actually had a very nice offset in which the credit spread had a certain amount of loss, the directional calls had a certain amount of gain, and in the end, by the time I got out of the credit spread, because I actually thought Google would pull back a little more, my net loss is about anywhere from $10 to $20 a contract. So very small loss compared to the directional move. So if you trade the proper way with the good price controls, utilizing very distinct protective strategies, credit spreads can be always a good way to trade. You just need to be able to understand how to manage the trade when it starts to go against you.